Welcome back, Alpha Hunters. The thing professional traders know and can execute better than amateur traders is risk management. Keeping it 100 with you, this will either lead to your long-term success or you giving all your money to the market. It really doesn't even matter what trading strategies you choose to implement. In this video, we'll be covering a breakdown of capital allocation, risk amount per trade, and how limits keep your risk in check. See you on the other side. Your best friend is going to be the stop loss. We are all human and we make mistakes. And we are going to be wrong, especially in trading. If you are a married man, maybe it's just best you don't even trade because you guys are never right. But we expect our best friends to keep us out of trouble, and that's what the stop loss will do. Keep us out of trouble. We want to make sure one losing trade doesn't destroy our accounts or just ruin the numbers game. Because trading is just a numbers game. Now let's start by looking at how to calculate risk amount. How much should I risk and other risk limits. Okay, so let's look at how to calculate our risk per trade, or R. R is just meant to easily standardize your risk unit. So if you hear R going forward, this is what it means. It also has psychological benefits as you don't think about trading money, but units of risk. So over a period of time, as you make money or lose money, you just want to think about it in terms of R, not dollars. But ideally, you want your R to be between 1 to 5% of your account value. This can go up to 10% on smaller accounts, but you want to stick to swing trading only. I consider small accounts anything under
$1 million.
Now, anything under about $2,000. If you find yourself in this boat, it's not a problem. You just need to be limiting how much exposure you have at any one time. What I mean by that is don't have too many trades open at once. So no more than 30% of your account should be at risk. Let's say you have 60% of your account in open orders or open trades. But if they all lose, you wouldn't want to be losing more than 30% of your account through stop losses and other kind of protective measures. Now, this might be all you can invest at the time, or this might be a little of what you have to invest. Either way, take it seriously, learn, and you will see results to where you can invest more later, or you just wind up growing this. In between about $2,000 to $5,000, you want to be reducing the percentage to calculate your R to the 1 to 5% area. I'm here for you if you need guidance during this period, if it seems scary or unsure in any way. Just ping me. I have some great option strategies for these kinds of accounts that I'll be showing in videos later on when I cover options. So how you calculate R is to multiply your account value and the percentage you choose. So in this example, the account value is $55,000 multiplied by 3%, and that'll get you an R of $1,650. That would be your R going forward, your risk per trade. Let's look at another example. Let's say your account is $27,500, and you want to use 1.5% to calculate your R. That will get you an R of $412.50. Now, I would round this to either 400, 410, maybe 415. I just like things to be clean, but you don't have to. I wouldn't round up much though, as that could lead to throwing some risk calculations out of whack. This will allow you to standardize your trading risk and make it easy to calculate position size for trades. Now, as you are successful trading, your account will increase and you will need to adjust your R, or your returns as a percent of your account will continue to decrease. So every now and then, you'll want to compound your account. Basically means recalculate your R and make sure your account is within your capital allocation or make adjustments as you need to. How often should you compound your account? I do it every quarter, but the other common time frames are biannual, so every 6 months, and annually. There's no right or wrong way to go here. And I have set up a repeating calendar reminder to let me know when I need to compound. So you also want to have trade number limits. This way you don't overexpose your risk to the market at any time or given day. I strongly recommend in the beginning doing a maximum of 2 day trades. Today could suck, but you don't want it to end you. Another good limit to have is how many swing trades you have open at any one time, especially if they are all in the same direction, bullish or bearish. As with anything, once you understand risk being taken, you can increase the numbers you have open. But if the market has a pullback and you are overexposed, you can have significant losses in your account. Next, let's look at capital allocation breakdown. I'm going to share in order my preference on where you should prioritize your capital. And really, this order is going to be for those that need to grow their accounts. First would be to focus on swing trading. These are trades that should be taking days to weeks long, maybe a couple months, but not typically. This will allow you to get a feel and understanding for the market's movement, orders, both entry and exit, stop orders, how to adjust open orders, how your P&L moves with the trade, and just typical familiarity. This is good for any amount of capital in an account. Next would be day trading. These will be trades that are opened and closed within the same trading day. Most day traders will have margin accounts. The other kind of account is a cash account. I'll go into more details on the kinds of accounts in a different video. But these trades will increase or decrease your account much faster than swing trading, as you will typically have larger positions and you will expect significant movement during the day. It's a good idea to first use a fraction of your R, risk per trade, to understand the situation. Don't think day trading is where the money-making opportunities are at. But you'd want to have a $25,000 account for margin trading or a $15,000 account for cash account trading. It's going to depend a lot on the price of the stock you are trying to trade though. Now I put cash third in this list as it falls between day trading and long term, which is next. Have cash that you choose not to use can be used to generate returns. This will allow you to sell options, generally net credits, and generate cash flow, especially against long-term holdings. Speaking of, long-term is where you can build great returns and wealth in combination with options. But you can let this really start to take over your account once your capital is increased. I'd say around $30,000 is a good number to start getting into long-term investing. I'll show you a strategy that I produced in another video series, and it really doesn't require that much capital to start building a long-term portfolio. A movie about finding undervalued talent in baseball using numbers is Moneyball.
It's about getting things down to one number. Using the stats the way we read them, we'll find value in players that nobody else can see.
And in trading, it's really no different. You are just trying to reduce trading strategies to numbers to see if they bring value. By the way, Moneyball is a great movie and I highly recommend watching it. So let's say you have a win rate of 40%. You might think, gosh, that is a bad strategy. While it might not be the best, it can still prove to be a profitable strategy. But this isn't enough information to tell the whole story. We need to also understand the reward to risk ratio. For example, you want to buy a stock at 53 with a stop loss at 51, then your take profit would be at 57. You're looking for a $4 reward from 53 to 57, and a $2 risk from 53 to 51. So you have a $4 reward and a $2 risk, then divide both numbers by 2, and you get a 2-to-1 risk-reward ratio. Okay, now we have enough information to figure out if this strategy brings value. Let's say we took 10 trades, with 4 being winners, as that would be a 40% win rate. The 4 winning trades times $2,000, which is the R, $1,000, and your reward, 2, would generate $8,000 in profits. And the 6 losing trades would generate $6,000 in losses. Adding the $8,000 in profits and the $6,000 in losses would generate $2,000 in net profits. So, even though the strategy has less than a 50% win rate, doesn't mean it isn't bringing in value from profitability. As time goes on, you will learn to find strategies that are better than 40% and manage trades better so you aren't losing your whole R on losing trades. So I hope a lot of this made sense and was relatable and made it clear on how to calculate how much you should be risking per trade and to stick with how much you risk per trade for a given period of time. Let strategies work out, figure out how they work over time, what the profitability is, what kind of win rate they have. That way you can better determine the longer term success of a strategy. It needs to work for more than just one or two trades or just a week. Also showed you some general guidelines that you should stick to until you get a feel for how you want to run your portfolio and your strategies fit into the plan. But over time, you will fine-tune your risk and limits to become your own. Losses are going to happen. Just stick to the plan, and the wins will also happen. As always, if you need help with anything, just ping me down in the comments or just send me a message. All right, take care, Alpha Hunters.